Hello students, welcome back to this another video on closing entries we have prepared for you. As we have already in the previous video I have already talked about how the closing entry journal is done, okay, in detail. But in this video we will try to show you what is actually happening in the accounting process by this closing entry thing. So just for a review, what is actually happening, I have already discussed in the previous video that closing entry, normally what they do by using income summary account to close the revenue and expenses, and at the end by closing the income summary account with the help of owner's capital, right, we are actually transferring our net income to owner's capital. You have seen in the third journal, right, income summary was debited, owner's capital was credited. So that's actually what we have done. Suppose in a particular another example, if there is in net loss in place of net income, the treatment will be the opposite. At that time the owner's income summary will be credited, owner's capital will be debited, okay. And in the closing entry, the last closing entry, we have transferred the owner's drawing to owner's capital. To make the owner's drawings account balance 0, we have debited owner's capital and credited drawings account. I hope you remember because that's already in the previous video. And what is the effect if we do that? After doing all the 4 journals, the balance in our every temporary account, the revenue, expense and drawings account will be 0. And when we prepare the closing entry, a company normally prepare closing entry, journalize and post closing entry at the end of the accounting period. What do you mean by post? That means this closing entry, as every journal, these closing entries have to be posted in the appropriate ledger account, so that the ledger account balance of this temporary account will get 0, okay. So this is all about the summary of what we have learned till now, the basics. And now just for a demonstration purpose, just see what is happening by the closing entry. Now we can see that what is the effect our closing entry will have if we post the closing entries to respective ledger account. Let's start with the revenue account. Suppose this was the revenue of a particular year. We have earned revenue of 10,000, 400, 200 particular accounting period, okay. So total revenue was 10,600, and in the closing entry we have debited it by 10,600, so that our balance at the end becomes 0, okay. So there the debit side and credit side are equal, balance is 0, there is no balance here. Why? Because of the closing entry. Same thing has happened to the expense. Suppose these are my expense account, they normally previously had a debit balance, but when in the second journal we have created each of the expense account, then their balance becomes 0. This ledger balance has become 0, right. And this time when we close the revenue account, we have created the income summary account, and when we close all the expense account, we have debited the income summary account by 7740, and in the third journal we have debited the income summary account to make the balance of income summary account 02. And whenever we debited income summary account, which account we have created? Exactly, we have created the owner's capital account, because profit increases owner's capital. So the owner's capital has increased by the third journal, okay, great. And next, last journal, we have made the balance of owner's drawing 0 by creating the owner's drawing by 500, so the balance becomes 0. And when we created the owner's drawings, we have debited the owner's capital, and that debit 500 will reduce the owner's capital by 500. So what is actually happening is that whatever we are doing here, many things are happening. Our temporary accounts balance has become 0, will become 0. Our owner's capital account will get adjusted. Because of the profit, the owner's capital will increase, and because of the drawings, the owner's capital account will decrease. So it's not like that you can just close some accounts and not transfer the balance to anywhere else. That's not going to happen in accounting, okay. So because of this, our owner's capital balance got changed. Okay. So this is the actual effect of of closing entry on the accounting process. So again, we have already talked about it, that in our accounting process we prepare trial balance 3 times. One, the normal trial balance, then the adjusted trial balance, and the last one is the post closing trial balance. Trial balance is very easy, right? You just get the balance of all the ledger account at a particular point of time. So in a particular point of time, after preparing the closing entries and posting the closing entries to the respective ledger, we can prepare the post closing trial balance by the ledger balance. And what will be the difference of this trial balance with others? Very simple. As you can see here, that in this trial balance you will not see any of the temporary account. Temporary account means any of the revenue account, any of the expense account, as well as any of the any of the drawings account. Okay, this is what going to happen here. So only asset account, liability account, and owner's capital account, as simple as that. This is what is known as post closing trial balance. In the post closing trial balance, there is only 3 type of account, or the permanent account only, which are asset account, liability account, and owner's capital account. So with this, we complete our discussion of closing entry. In this part, we have, in this 2 video, we have discussed about the closing entry journal. We have also discussed about the how to post the closing entry to the respective ledger. We have also talked about in the post closing trial balance, and we have also tried our best to show you the effect of closing entry on the accounting process. So with this, I conclude this video. Thank you again for your patience throughout the lecture. Hope to see you soon with another video. Thank you.